Okay. Now we go to inherited property basis. This is something that came to you because somebody died and you were the beneficiary of that asset. Okay. Uh, which was the latest case? I was just reading it a couple of, oh, this Rohit Bhai, this guy who was a designer in India. He has left behind a will where a lot of money is given to a guy, and his family has come ahead and they have started debating it. Same thing happened when Priyambada Billa died. She left her property in will to somebody, and the whole problem happened. Right now, the question is, when somebody dies and your name is mentioned as a beneficiary, and if that property passes on to you inheritance, how are you going to record that property for IRS purposes in your books? Now, always remember dying is a taxable event in the US. Now, it has a positive connotation because, see, again, I will share a podcast. Let me just figure that podcast. It was such a nice podcast. The podcast was on why most Americans do not evade taxes. And they said one of the reasons is that the the impetus to evade taxes is very less, because if you look at the way the taxes are being designed, people would buy, borrow, die. So they would buy an asset, let's say stock. When they want to use the asset, instead of selling it, because the moment you sell it, that is the time when they're going to charge you and ask you to pay tax. So don't sell it, borrow money, give that stock as a collateral, use the money. When you die, the property is still valued at the net adjusted basis. When you die, that day the property is marked at fair market value, and the person who gets that property gets it at the increased value. Who pays tax? Ideally, nobody. Because throughout the lifetime, apart from gifting somebody $18,000 per donee per year, there is a big amount that I've given you, which ideally should take care of everything. And nobody would have to pay any tax. So during your entire lifetime, you use the property, don't pay tax. When you die, the property value is increased to fair market value on the date of, and that value goes on and becomes the value in the hands of the purchaser. So he or she will also not have to think about the past problems. The day when that property came to you, that property came to you free of cost at the increased fair market value or the decreased fair market value on the date of the inheritance. So that's the logical concept. How are you going to technically learn this? So always remember first that whenever there's an inherited property, it is always long term to you. And it does not matter whether that property was actually long term or not. The idea is on the date of death, time freezes. If you guys have ever read Charles Dickens, what is the name of that book? Great Expectations. Time freezes when somebody dies. Okay. So the way you've got to look at it is the day when somebody dies, the property is always long term to you. So there was a person, very old, got a car, used it for a couple of days, and died. And that car came to you as inheritance. Ideally, that car is not even a year old. So it looks like a short term property. But the moment it becomes an inherited property, it is always considered a long term gain. Always long term. Ideally, I will freeze it on the date of death. Whatever is the fair market value on the date of death, that value will be considered your value. The only exception is sometimes, now see, I have discussed this already. And when the person dies, and we did it when we were doing IRD, income with respect to a resident. When the person dies, automatically the property goes on to the estate. Now, there is somebody called the executor of the estate. Now, generally, people would either name the executor in the will. If there is no will and if no executor has been named, then the state would appoint an executor. Now, on this day, so the day when the person dies, everything is valued at fair market value, and the executor will file a return. I think it is 706 or 709, either of the two. I kind of confused between the two. So there's some 700 return, and this return is like a wealth tax return. On one day, we are going to calculate what is the fair market value for all the assets, reduce that final gift tax exemption, and then if there is any delta, you're going to pay tax on it. So it's a one-time wealth tax. And then this executor will, let's say, will have five, six beneficiaries. The executor will just distribute all the assets to the beneficiaries according to the will that has been written. Now, in this intervening period, the estate will keep on earning money. So if there are properties on rent, rent will keep coming. If there are stocks, there would be interest, dividends, all of that keep coming. So in the intervening period, the estate will also file something called Form 1041, which is the income tax return of the estate. So ideally, how many of the estate? So how long do you get to have this? Typically 9 months. From the date of death, you will have 9 months time to wrap up everything. There will be a wealth tax and there would be a income tax. So ideally, at what value will the beneficiary receive the property? Ideally, it is fair market value on the date of gift, but there is an exception. What is the exception? The exception is if the executor chooses, that the idea is totally dependent on the executee, he may choose a date which is 6 months after the date of death and will take the fair market value of all the properties, provided now this value is lower as a whole. We are not taking individual assets. If you take the estate as a whole, and 6 months from the date of death, if the value of the property is expected to go down, then you can choose an alternate valuation date and take the fair market value of the asset on the alternate valuation date, which is 6 months from the date of death. But what happens if the beneficiary receives it somewhere, let's say after 3 months? Then what do? Then you say, okay, let it be very clear. General rule, the inheritor will take the property as a long-term property, irrespective of the number of days, months, year when the property was held by the deceased. The property comes to you as long-term, and generally you take the fair market value on the date of death. But there is an exception. If the executor chooses an alternate valuation date, then the value of that property is what? It is the lower of the two dates. It is the lower of fair market value 6 months after the date of death. 6 months after the date of death, that means either this or the day of distribution of property, whichever is earlier. So if you actually distributed that property after 3 months, then you cannot take a higher value. You take the fair market value on the day the property was distributed. Wait, I'll give you the concept here once more and then we'll take a couple of questions which will establish this. So this is the same question that I gave you. Uncle bought a car 2 days back. Dies. And the car passes to you. General rule, the property will always be long term and it doesn't matter whether you have to increase the price or reduce the price. You're going to assume the value at fair market value on the date of death. And that value on the date of death, whether it is up or down, becomes your basis. And the property will always be considered long term, irrespective of how many days the property was actually been acquired. So it's always long term. Now that's the general rule. What's the exception? The exception is if the executor chooses an alternate valuation date. If the date is chosen, then you have to take the basis as a fair market value of the earlier of what? The day when you actually distributed property, in case if you distributed it earlier, or max to max, I will allow you 6 months from the date of death. So if you're distributing the property, let's say 9 months, you can take the fair market value only after 6 months from the date of death. That's the maximum I'm going to allow you. If you distributed it, let's say after 4 months, then I'm going to take the fair market value on the date of distribution. If the executor did not choose the alternate valuation date, then you're just going to take the fair market value on the date of death. Now, generally, please remember, we don't go by individual valuations. Alternation valuation date is generally only available if the overall gross estate valuation is going to come down if you choose an alternate valuation date. So generally, you're not allowed to do this if the value goes up in 6 months' time. You're only allowed to do it if the value comes down in 6 months' time. Value of not an individual asset, but the estate as a whole. Very slowly do the questions. Initially, when you do the questions, your aim should be to get it correct. Forget about the time. Because if you get it correct, you know that you've understood the concept well. Don't rush. These are easy questions which will fetch you full marks if you pay attention. Okay. Peter's basis in inherited stock. So the moment you hear the word inherited, you know general rule long term fair market value on the date of death unless alternate valuation date is chosen. Okay. Peter received 50 shares of stock as an inheritance on July 15th of the current year. So date of distribution, we already know. How much is the date of distribution? July 15th. From his father, so this is father and this is the taxpayer. Who died? So date of death is how much? April 25. So automatically 6 months from the date of death. So it's April, May, June, July, August, September, October. So this is October 15. Now we know everything. Okay? Now we just need to know the values and whether alternate valuation date was chosen or not. Okay? His father's adjusted basis in the stock is 80. It is an irrelevant data for us. Okay? The stock's fair market value on April 25 is $84,000. On October 15th of the current year, its value is $90,000. And on the date Peter received the stock, its value is $82,000. This is a redundant information. The alternate valuation date, this is very, very important, was not selected. Can you tell me what will be the basis of the stock in the hands of the taxpayer? Anybody? What will be the basis of the stock in the hands of the taxpayer? How can it be 90? Kannan, this is an irrelevant figure for us, isn't it? Kannan, what is the general norm? It is the fair market value on the date of death unless alternate valuation date was selected. If it was, then it is the earlier of the two dates, fair market value, either 6 months from the date of death or the date of distribution. So in this case, it will be the fair market value on the date of death, which is C. Why are the answers not coming in? Is this clear? Yes, no? How many of you are still confused? Okay, tell me if I would have told you that alternate valuation date was selected. Karsten, unmute yourself. Tell me what is the answer if I tell you that alternate valuation date was elected. What would be the answer?
I'm actually not sure. I would think it's still 80,000 because it's not 6 months.
No, wait. 80,000 is anyways not a part of the calculation because it is adjusted basis. Is
Oh,
this
right,
clear?
right. Yeah, correct.
So general rule, first question, is alternate valuation date elected? The answer is yes. If yes, then the rule says it is the earlier of the two dates, either the date when you distributed the asset or 6 months from the date of death. So which is the earlier date?
their distribution, so it will be 82.
It will be 82. If they tell you the property got distributed, let's say on December 15th, then we are saying, boss, we will not allow you to go beyond 6 months from the date of death. Then the value will in your hands will become 90,000. Is that clear?
I thought it's 6 months from date of death, no? Even if there's election.
So 6 months from date of death is October 15th, na?
Yeah, no, but in the December situation, you said
This is
it
the
will
date
be.
of distribution. In case, let's say, the
Oh,
beneficiary
date of
got that
distribution.
property on December 15th rather than July 15th.
Right. Then that would be
In that
90,000.
case, you will take the earlier of the two dates. The distribution date will be December 15th. The 6 months from the date of death date will be October 15th. So you will take 90,000. And you will ignore whether it is an up or a down. You will just take the figures. I don't care if this was 100,000 and you went down or it was 80 and it went down. Is that clear? Also, if I want to confuse you, I can give you this data with two, three more data. Apparently, people will confuse this, and I'll give you some data by which obviously this will look like a short-term gain property. Like the example that I took, I got a car 2 days back, right? The moment I know this data, my mind will say short-term, and immediately you've got to stop yourself and say no. It's an inherited property, always long-term. Inherited property, always long-term. Okay. Okay, this is a very good question, guys. Okay, very, very good question. See, what's the call of the question? Go slow. Whoever answers this correct in the first attempt, you have understood this concept, you have nailed this concept. Okay, understand. If you can understand this, we've really understood and appreciated the concept. What is the taxpayers? Who is Miss Michelle's basis as of the date of Mr. Abe's death? Mr. Abe and Miss Michelle purchased a small apartment house at the beginning of year one for $400,000, which they held for investment. Each furnished one half of the purchase price. Each had a half interest in the income from the property. They held the apartment in joint tenancy with the right of survivorship. That is, a tenancy in which the interest of the first tenant to die passes to the survivor on the death of the first tenant to die. So here we have a property which was part owned by Mr. A and Miss B. So this was 50% and this was 50%. And the idea was whoever would die, the ownership of that person will now go and rest with the other, the survivor. They depreciated the apartment house at the rate of $10,000 per year. On December 31st, year 8, so this was year 1, after 8 long years, Mr. Abe died. So this guy died. And at the date of Mr. Abe's death, the apartment had an adjusted basis of $320,000. And on that day, the fair market value of the property was 550. Now they are asking you, tell me, on this date, on the date of death, what would be the basis in the hands of the survivor? This is so easy. See, I'm not going to be bothered by all of this because they've already told me. So this is a distractor. This is a distractor. Can you see? First, when you read the question, you need to remove all the distractors. Okay, in your mind, cross this. Okay, not needed. So now you know only two figures which are valuable. See, the one that I already have, that will become my purchased property basis. Can anybody tell me what will be the purchased property basis for Mrs. B? Her part. Her part would be half. Half of what? Half of 320? This is 160 because this is my property basis. And then Mr. A's part, which was also 160, now I'm going to take this in my books at fair market value on the date of death. Which will become what? Which will become half of $550,000, which is how much, guys? Which is $275,000. So this property is now in my books at 435 to 25 to 75. Is the concept clear? We have mixed the purchase property basis and the inherited property basis concepts, and we have discussed one concept which is applicable now. Is this clear to everybody? See, if I want to confuse you, there's so many places where I confused you on this question. The same question I can give it to you as a sim. The same question I can give it to you as a applied sim. I can confuse you with two or three other data. I can say that the house was bought just 1 year back, 9 months back. So remember, if she now sells it, this part is going to be normal short term. But this part will become long term because this part is long term capital gain. So I can confuse you with a lot of stuff. Understand the provisions. You may solve 10 questions or you may solve 300 questions to know the same concept. The moment you understand the concept well, you move on to the next concept. And the concept should be so clear and your mind should be so still that when I throw you any questions, either as an application, as a DRS, as a diagnostics, everything I should be able to answer because the base concept does not change. Okay, I'll stop here today. So we have completed actually a lot today. Okay, more than what I had thought. We had completed, one second. We have, out of all the bases, we completed the purchased property, gifted property, inherited property. Okay, tomorrow we'll do these three. Okay, I don't think I will get a lot of time even now to do all the sims in the class. I'll do this sim, the balance two sims. Let me see, I'll choose one which is more important. Let's say the DRS sim, and the rest I'll give it to you as a part of your sim test if need be. Okay, I don't want to increase my number of classes here. By the way, at the end of our entire regulation discussion, I will have some dedicated 2 sessions of 3 hours each only for sim discussion. Please be there when I'm discussing those sims, okay, because it will kind of refresh all the concepts to you. So we have completed these three concepts today. These are actually relatively easier. We'll do these three. We will talk about some capital gain concepts and we'll take one or two. Let's see how much time permits the sim tomorrow. Okay.